Welcome to the Pro Ticker Deep Dive. Today we are diving into a company that, it's not making headlines for flashy consumer tech or
Right.
the latest generative software,
Mm-hmm.
and yet it's quietly becoming one of the best performing stocks of 2025.
Mm.
I mean, it's rallied an incredible 70.79% since just mid-February.
Mm.
We're talking about GE Vernova.
That kind of performance is, it's just staggering for what is, at its core, an industrial equipment manufacturer. It's
Yeah.
not an AI model, it's not some chip designer, but the market is clearly seeing something indispensable here. And that really brings us to our big question for this deep dive.
Why? Why is a company that specializes in, power generation and grid infrastructure suddenly leading the pack?
Exactly. Our mission today is to unpack how GE Vernova is positioned really perfectly at this intersection of energy infrastructure, digital transformation, and what is, I think, the most critical trend of the decade.
The AI energy build-out.
The massive, accelerating AI energy build-out. This company is just a pure play on infrastructure scarcity.
So this is the definitive picks and shovels story for the new economy.
It really is. And just to set the stage for everyone, GE Vernova is that late 2024 spinoff from General Electric. So it inherited all the legacy power and grid assets.
The heavy stuff.
The heavy, non-negotiable nuts and bolts of the power system. And what immediately signals their position, their scale, is this one number. As of Q3 2025, they have a $135 billion order backlog.
$135 billion. That's contractually committed, booked work, years of it.
Right. And to understand why the market is assigning so much value to that, we have to grasp the urgency behind it. We need to talk about the macro backdrop.
The energy crisis nobody's really naming out loud.
It's such a paradox, isn't it? Global electricity demand is accelerating at a rate we just haven't seen in decades. But the driver isn't just population growth or standard industry.
It's computation.
It's computation,
Wow.
specifically the insatiable hunger of AI data centers.
And the pace of this surge is what's so hard to wrap your head around. We're talking about data center energy consumption, globally projected to double between 2023 and 2028.
Double. That's a compound annual growth rate, a CAGR, of 19.5%.
And that's just for all data centers.
But if you drill down into just the AI-specific part of that, the growth becomes explosive.
Okay.
The CAGR there hits a stunning 44.7%. And if we look out to just 2027, AI data centers alone are projected to need 146.2 terawatt hours.
Put that number in perspective for us. How big is that?
That is the equivalent of the entire electricity consumption of the country of France.
Wow. An entire country's worth of new power needed in just a few years.
Just for one specific computing task.
That is the infrastructure gap we are facing. And long term, what are we looking at? The projections say by 2030, data centers could be eating up 8% of all global electricity.
Up from, what, 1 or 2% today? And, this isn't just about throwing up more solar panels. That's the critical distinction here. The existing grid, the transmission lines, the transformers, it was all built for predictable static demand. It just cannot absorb this kind of growth.
And these data centers, they need a specific kind of power, right? We're talking 200 plus megawatts of, what's the word? Continuous power.
Continuous, reliable power. Let's really focus on that word, continuous. It's so crucial.
Why is that?
Because foundational AI models, cloud infrastructure, these things can't handle intermittency. If the power drops, the computation fails, period. You cannot run Google or OpenAI on a solar farm that only works when the sun is out.
You need something you can turn on and off on demand.
You need dispatchable power, power that is there reliably when you need it. And right now that means gas turbines, often the high-efficiency HA class ones, which are, GE Vernova's absolute specialty.
And this is where it gets really interesting for me.
Yeah.
It's not just about the volume of power. It's about intelligence.
Yes.
These AI workloads create these rapid, spiky fluctuations in demand. So you need continuous power, but you also need it to be flexible.
Exactly. That is the dual play. Utilities don't just need more generation. They need smarter, more resilient grids and advanced control systems to manage all that volatility without, blowing up the local network.
So GE Vernova is selling both things.
Yeah.
The power plants and the brains to manage them.
They are. Which brings us to the next logical question. If the demand is that huge, why is GE Vernova the market's answer over, say, a Siemens Energy or an ABB? What's their actual moat?
Yeah. What makes them unique?
It really comes down to their integrated positioning and their sheer scale. They are basically the only major player that can offer a true turnkey solution that spans the entire electricity value chain.
And that's through their 3 segments.
Right. So first, you have power. These are the gas turbines, the generation source, the workhorse.
Okay.
Second is electrification. This is the infrastructure layer, the transformers, switchgear, and the software that physically connects and manages the power.
The grid stuff.
The grid stuff. And third, you have wind, which is renewables, though, that part is facing some industry headwinds right now.
We'll get to that. But that integrated approach, that's what creates the vendor stickiness.
Precisely. If you're a hyperscaler planning a new AI data center, you don't want to coordinate 5 vendors. You go to GE Vernova, and they can handle the generation, the grid upgrades, and the digital tools.
It minimizes the risk for the client.
And it means GE Vernova captures a much larger share of the total capital spend. That's why that $135 billion backlog is so incredibly valuable. It's committed work for projects that are structurally necessary.
So let's break down that Q3 2025 performance, because the momentum, especially in that power segment, is just staggering.
The power segment is absolutely the engine room right now. Organic revenue growth was over 40% in Q3.
40%.
Demand for gas power is so high that customers are basically lining up begging for capacity. We saw them increase their gas power slot reservations from 50 gigawatts to 55, and that demand let them expand EBITDA margins to a really impressive 16.4%.
And then there's the electrification segment, the grid hardware. You call this the growth accelerant.
It really is. Organic revenue there grew 20% in Q3, but the margin story, that's the jaw dropper.
What happened?
The pricing power there is immense. These are long lead time items. We saw EBITDA margins nearly double. They jumped from 7.2% all the way to 14.6%. Doubled. And the backlog there just ballooned. It went from about $20.7 billion to $27.5 billion just in that one quarter. Utilities are just desperately competing for that constrained supply.
Okay. But before we get too carried away, we have to talk about the elephant in the room.
The wind segment.
It's a major drag right now.
It is, and we can't ignore it. Management had to revise its guidance for wind. They're now assuming single-digit revenue declines and a pretty substantial $400 million loss in EBITDA for 2025.
And that's not really a GE problem, right? It's an industry-wide thing.
It is. It reflects this broader market paralysis in renewables. You've got permitting delays, grid connection issues. It's just hampering developers everywhere.
So even though management sees it as a near-term thing, that $400 million loss is a real anchor on the other 2 segments.
Absolutely. The whole bull case really hinges on power and electrification growing fast enough to more than make up for that drag.
So shifting to the overall financial picture, how does all this translate into the full year 2025 guidance?
Well, overall revenue is trending toward the high end of their guidance, so probably landing between $36 and $37 billion. That's a huge 30 to 35% increase year over year.
But the real story is margin expansion.
It is. Adjusted EBITDA margins are projected to expand pretty significantly. The guidance is now 8 to 9% for the full year, and that's up from just 6.4% in the previous quarter.
And what's fueling that? We talked about volume, but what else?
It's this beautiful cocktail of 3 things. First, you have pricing power. It's the seller's market.
Right.
Second, operational leverage. They're just pushing more product through their factories. And third, a favorable mix shift. The high-margin power and electrification businesses are just becoming a bigger piece of the pie than the low-margin wind business.
Which brings us to free cash flow, where we saw a really dramatic upward revision.
This part is so critical. It gives you an insight into their market leverage. They raised their FCF guidance up to $3.5 billion. And the reason for that massive jump...
It's not just execution.
It's not just execution. Customers are paying huge cash deposits up front just to secure those production slots for turbines and transformers.
So they're getting paid to reserve capacity.
They are. It accelerates their cash flow and strengthens the balance sheet. They're targeting 100% FCF conversion by 2028.
And having all that cash allows them to make big strategic moves. Which brings us to the Prolec GE acquisition. Why spend over $5 billion on a transformer company?
Because transformers are the biggest choke point in the entire system. They are these custom-built, specialized pieces of equipment. Lead times for some of them can run 2, even 3 years.
So by buying the rest of Prolec GE, they are vertically integrating. They're taking control over the most constrained part of the whole chain.
Exactly. It lets them accelerate their own projects, prioritize their own needs, and crucially, capture the full margin on that highly constrained equipment. It just makes the electrification segment even stronger.
And we're seeing tangible contracts roll in, too, like that Chevron partnership.
That's a direct response to the AI power crunch. The partnership is aiming to develop 4 gigawatts of new gas-powered generation.
Specifically for data centers.
Specifically for U.S. data centers by 2027. It's just confirmation that the big players are relying on GE Vernova's turbines to solve this immediate crisis.
Let's also touch on the software play here, GridOS, because this is where the long-term margin story could get really interesting, beyond just hardware.
GridOS is the intelligence layer. It's a suite of digital products that helps utilities manage all that complex, volatile power demand we were talking about.
So it's not just a shiny app.
No. These are mission-critical tools, things like GridBeats for predictive maintenance, or the GridOS data fabric, which helps utilities manage power flowing in 2 directions, which you need for solar and batteries.
And that kind of software offers recurring, high-margin revenue. It could fundamentally change their revenue profile after 2026.
It turns a one-time hardware sale into a decades-long service relationship, and that is the mechanism that helps justify the higher valuation the market's giving them.
Okay, speaking of valuation, we have to address the risks. An EBITDA multiple of 52.58 times that's very elevated.
It's extremely high. I mean, most industrial peers trade in the 15 to 25 times range. That 52x multiple signals that market is treating them less like a traditional manufacturer and more like a high-growth infrastructure services company.
Which means there is very little room for error. What could derail this?
Execution risk. That's number one. Converting that huge backlog efficiently and profitably takes immense discipline. If they hit quality control issues, labor shortages, supply chain snarls, the market will punish the stock because that valuation prices in near-perfect delivery.
And we also can't ignore the regulatory friction. Tariffs.
Right. Tariffs have been a real headwind, an impact of about $300 to $400 million in 2025. Now, management says this is priced into newer contracts, but ongoing trade friction that always introduces volatility.
Let's do a quick technical snapshot. Despite the huge rally, what's the momentum look like right now?
Well, the 70+% rally shows incredible enthusiasm, but the annualized volatility is high at over 51%. Right now, we are seeing some consolidation. The Relative Strength Index, the RSI, it's pretty neutral at 52.97.
It's not overbought.
It's not overbought, which suggests there is technical room for more appreciation if the fundamental story holds up.
And what are the key levels people should be watching?
The big one is the 52-week high resistance from September 2025. That's at $677. Clean break above that would be a very bullish signal. On the downside, you've got critical support at the 50-day moving average, around $593, and then another line at $560.
So to bring it all home, the core thesis is that GE Vernova is essential, structural, and capital intensive. It's the picks and shovels play that a lot of investors focused only on AI chips are totally missing.
It's the durability of their advantage. That integrated positioning generation, grid, software, it lets them solve the client's single biggest problem, getting reliable power. If they can execute on converting that backlog, the tailwinds from AI and just global infrastructure renewal are enormous.
Okay, let's leave you with one final thought, something that extends their advantage beyond just the AI boom. It builds on this idea of energy transition. The push for decarbonization creates a second dual-fuel opportunity here.
This is a massive long-term catalyst. Many of GE Vernova's advanced gas turbines, their H-class series, are already designed to run on increasing blends of hydrogen.
So as green hydrogen infrastructure gets built out,
Their existing turbines and all the new ones they sell, they become instantly relevant to that clean energy transition. It creates this potential second wave of CapEx where utilities upgrade their turbines for zero-carbon operations.
so they get to participate in the AI build-out today.
And secure the decarbonization CapEx of tomorrow.
See you all in the next Pro Ticker Deep Dive.